Morning and welcome to the Global Morning Call. Today is Tuesday, 6th of February 2018. It's been a very interesting move that we've seen the last 24 hours on the equities market. And here to discuss on the FX side to begin with is John Hardy.
Thanks, Yasser. Let's look what's going on here. First thing to look at, of course, is we have seen a very scary blow up. A lot of that concentrated in equity markets, obviously, and most specifically in U.S. equity markets. If we look across at the risk and global contagion globally, we're seeing a very interesting divergence from previous episodes of this nature. We're not seeing, so far, total global contagion here. We're not seeing, for example, dollar yen melting down below support. We're not seeing emerging market currencies doing more than simply consolidating a bit after a very sharp run higher. So at this point in time, it looks like a very concentrated phenomenon, a lot of it driven in the U.S. equity market, and I'll let Peter get into the details a little bit there, but just for perspective, you're seeing that a lot of this is driven, we think, by these insurance selling or negative convexity trades where people are assuming they can just continue to sell volatility and it pays off as it has been for the recent couple of years. But of course, when this trade goes bad and you get the 100-year flood, if you will, and you've been selling insurance, everything comes unwound at once because your assumed risk of one suddenly becomes a risk of 5 times, 10 times that in very quick order as the negative convexity kicks in. So that's the driver here. And so far, this is fast money. This is algorithmic type of money. This is a margin call type of money that is driving these trades. And the next critical thing here is if this is going to spread, we're not going to start ringing all the alarm bells yet. It's whether the slow money starts to move, whether the models that have now been severely tested, stress tested on this with the value at risk and other measures of risk, whether they need to feel like they need to deleverage as well. So I think in that respect today, a very critical day. And we want to look at a couple of things here. We want to look at treasuries. We want to look at currency market, especially yen trades, yen crosses, whether it's dollar yen or any other yen cross. And we want to perhaps look at something like the 200-day moving average in the S&P, which was the point at which the futures bounced overnight in off hours in the U.S. Also keep in mind if one is the right way around in these trades, we've already seen this morning the volatility when you're in the window of these types of events gets extreme in both directions. So we've already seen something like an 80-point bounce in the S&P futures overnight. Volatility can go both ways. At some point when markets get this excited, you'll see official intervention as well. I think already I'm suspecting one of those rate hikes out there from the Fed is getting priced out, and more could be to come on that account if this volatility continues to this degree. So we are inside the fat tail of distribution risks. Correlations, risk going to 1 if this gets any worse from here, and you get discontinuous pricing. So please respect the risks, even if we're not necessarily saying that if everything's going to continue to crash and fall apart, we need to respect the risks when we're inside the window of an event like this. And how do we protect ourselves? There's no cheap way to do that. There never is, especially once the volatility beast has been unleashed. But you can look at yen calls. Already dollar yen volatility for 1 month has gone from a 6 handle to a 10 handle, but it's still not particularly expensive relative to past market meltdowns. So yen calls, that means dollar yen puts or other cross yen puts, well out of the money as a portfolio protection measure. U.S. Treasuries as well. Here I have a chart of the positioning in the 2-year. This is the futures positioning for measured by the CFTC for 2-year futures, U.S. Treasury futures. And we can see the positionings have been extremely short as the market is pricing in all of these Fed rate hikes. If we start to suspect that this meltdown is becoming large enough that we have to unwind some of the expectations from the Fed, we could get tremendous volatility and short covering the other way from a portfolio perspective at the short end of the curve for here. And we get surprising volatility relative to past volatility and relative, of course, to this tremendous positioning, which is at record, I assume, record highs. I haven't got the data back before 2008. Okay, so respect the risks. Also respect that this could be suddenly over in terms of this immediate event, but this has really changed the volatility environment we feel for the duration and changed a lot of the market's assumptions. So we can easily say we're into some kind of new market era, regardless of what comes from here. And I won't even bother on the calendar today. Do keep in mind we have the Bank of England on Thursday. And I'll put you over to Peter on equities.
Thank you, John. So we will try to be as quick as possible, but I don't think we can be within the time limit today. There's so much to focus on. So first of all, what we saw yesterday in equity markets was the largest 2-day sell-off since the flash crash in 2015. So the flash crash in 15 and the crash we had yesterday are the two biggest two-day events we've had since the beginning of the expansion, since the financial crisis. So this is a big event. So what's going on, basically, what we're seeing is that, from my point of view in equities, what triggered all this was the Friday's weight numbers that really started a chain reaction, because you saw the continuous move up in US rates. At one point we got beyond the inflection point where we went into a sort of a technical sell-off. It was exacerbated, as John said, by the VIX short sellers. You have the VIX here to your right, so it's touching 37 right now, on par with what we saw during the flash crash. So that sort of accelerated to the downside in markets. We have seen a top to bottom move in the S&P 500 futures around 12%. It's stabilizing. I'll come back to that in a few minutes. Interestingly enough, the utilities, as I mentioned yesterday, was the natural safe haven. But then also real estate was the second best bid sector yesterday, and obviously driven by the response in the interest rate. So people were fleeing into that sector. That's a kind of an odd move, I would say. Utilities is typically the classic safe haven. If you look at market structure and dynamics from a statistical point of view, you have VIX levels at 30 and 22 are crucial lines in the sand where you move from one regime to the next. I highlighted it on Twitter yesterday around midday, so I really recommend you to follow us on Twitter, where we sort of put this piece of information out. We broke through that 22 level. We shifted into a new regime. We had the technical sell-off accelerating, and we pushed through 30, and then everything went to hell. If you look at this is the S&P 500 here. As I said, we're bouncing back. I'll touch about that in a few seconds. This is the short VIX futures ETF, as John also showed you. This is the one that took a 50% decline, and then in the aftermarket trading, there was discontinued pricing. Everyone was just selling, and we actually had the last quote down at 14, just to give you some perspective here. So that's a 90% decline in a very few days. So watch these levels in VIX. These are the regime change levels. We are already up 2.6% from the lows in the S&P 500. The 200-day moving average was the exact line of support coming up in the S&P 500. I remain of the view that would be the crucial area. If we break through the 200-day moving average in the S&P 500, I think we're moving into a new regime with even more volatility. So keep a tight eye on this level. If volatility comes down from these levels and we don't break through the 200-day, we could potentially see a very short lift for this correction, as we've seen so many times in the past few years. As John said, the low volatility regime is likely dead. The 2017 and the start to 18, it was a crazy anomaly in markets, and I don't think we will see a repeat of that anytime soon. Wrapping it off here, I will say the main thesis here on equities is that this is I think it's a late stage panic of a potential big regime shift in macro conditions because of the interest rates and inflation. The recession probability is still low, so if we get the volatility under control, the markets sort of go and become more well behaved over the coming days, we could see, I would not be surprised to see a final leg up in this expansion, but that's something we can touch on the coming weeks. But I've talked enough, and I'll give the word to Ole on commodities. Thank you.
Thank you very much, Peter. Yes, we are seeing obviously the impact on these the stock market route hitting both oil and while underpinning gold, as I mentioned here. Gold is holding up relatively well. The lower yields we've seen yesterday, and now also lower rate hike expectations for 2018 is supporting the price. And we have to remember that gold buyers in recent months, they have been looking to gold for safe haven and diversification away from a market that was getting increasingly complacent. These guys are now being rewarded, and an unchanged price in gold is for these guys very satisfactory. So not potentially looking for absolute returns, but just looking for relative returns, and they're getting that right now. But if you just look at gold, there is a bit of a bull flag building up here, and which if triggered, if we move above 1345, we could have a minimum target of up towards 1385. That's just using hits from this latest low, potentially could be higher. So just look at for the 1345 to the upside. It also means that options on the gold futures is being looked at. 1350 call to expiry on 26th of March is trading at 22.5. 1375 call expiry same time is trading around $15. So these are some of the ways that the upside could be looked at. the gold-silver ratio, just like we're seeing relatively calm in the forex market, we're also seeing relatively calm on the ratio to silver. It's trading just below 80. It could be an indication of it does indicate that the market remains relatively calm amid all the turmoil that's unfolding elsewhere. But that is and remains a key level for this ratio. Crude oil is being knocked lower together with the energy stocks. The XLE ETF is now down 11% from the January peak. XOP is down 14%. And we're seeing this risk off hitting oil because there is when we're seeing risk off, positions need to be adjusted, and we have the biggest positions of them all in the oil market. Hedge funds holding more than 1 billion barrels of oil, and the risk is that needs to be reduced. WTI for now is holding up above support. 62.50 is probably going to be the key level there. But what I've alluded to on Twitter as well, and in my recent updates, is the fact that while speculative buyers have been accumulating a record long, we've seen hedgers accumulate a record short. What happens when the market starts to correct is that the short sellers, they're not in any hurry to cover their shorts because they're hedging production. That basically means that we sometimes see these uneven market conditions, which is why all long liquidation phases can be painful. But we haven't really seen any acceleration yet, but it's just something that needs to be kept in mind. Later today, we have the API from tonight on inventories. We got the EIA tomorrow. Also today, we got the short-term energy outlook from the EIA. It's going to be interesting to look at their outlook for demand and supply. Just to finally, biggest hedge fund exposures right now, if we're looking at risk off, it's WTI, Brent, gas oil, gasoline, gold to a certain extent, palladium, platinum, and sugar, where the big position is short. That's it from me. Good luck out there, and over to Kim Kramer on technical outlook.
Yes, the usual suspects, and thrown in a few more. Let's start with Nasdaq Composite approaching key levels. Yesterday, this is the CAS index. I wouldn't be surprised if we start down around 6,900 later this afternoon when it opens. Look out for a break of this. But as you will see later, it seems like we are bouncing a little bit on the futures, although starting lower. S&P 500. Well, everyone was talking about 3,000. I mentioned last week that maybe it could be a hard sell to get up there. Support here around 26, 25 is, but the biggest and most important one is 25.64. We don't really want to see a break below that. I mean, it might pinch through it this afternoon as the future has been testing the 200 moving average, as Peter mentioned earlier, but we're bouncing also quite a bit here. So maybe we'll see. I expect to see a rebound from this sell-off here, and also going into the next couple of days. I think it will calm down a little bit, and then we'll bounce back. DAX support's broken. We definitely have a bear trend. Market is indicating we should trade below this support line here at 12,765. There isn't any support before around 12,000. You can see we actually went up more or less in a straight line back then. So there's not much technical support. However, I do believe the next couple of days we will see DAX trying to climb above this support line that it broke yesterday. Whether it will succeed or not, that's going to be interesting next week or so. Europe in general looks weaker than US in general. Moving on to, there's been talk a lot about VIX. Yeah, we were back to 2015 volatility. Expect more volatility going into the rest of the year, but I don't think we should call it doom and gloom yet. What was the crucial thing or the thing that happened yesterday? Actually, look at the ETF on financial SPDR ETF. It actually touched the support line just around 27.65. That is it tested yesterday and bounced a little bit before closing. Maybe we could see an opening above, below, but I would expect it to trade higher a little bit in this session tonight. But next strong support 26 if we continue further down. But I expect a short-term bounce at least. US 10-year. We talked about it last week. This is the monthly one. Monthly chart. It broke this very important level here around 122.25, and bouncing a little bit this morning, so we see the interest rates dropping a little bit, but there isn't any real support before the 200 moving average and actually the 117.5 short-term bounce here, but the US 10-year is in a bearish mode. And as Ole mentioned, gold spots. Yeah, it could be a bull flag. It could also be a little bit of a shoulder pattern formation. Look out for a break or not of this maybe a rising neckline. If it breaks below, well, then you will see it down to around 1300. Otherwise, we're talking about 1375. You can follow that pattern unfolding and other patterns on FX unfolding on Saxo Trader Go trade systems. Thank you very much.
Thank you, Kim. Just to round up, there's been a bloodbath in the equity markets, driven mostly by the US equities. This has been concentrated so far, so we're not seeing it in FX in the classical terms. If this should continue in the FX market, if looking for protection, buying dollar yen puts out of the money could be the way to look at it. Also looking at further protection by buying US Treasury call options on 2, 5 and 10 years. S&P has crucial technical support at 200-day moving average. If this is taken out, could open up for further drops. And gold, looking at technical resistance 1345. If that is taken out for possible higher moves, if also looking for protection, could be looking at calls in gold 1350, 1375 calls for expiries 26th of March. Be very careful out there and respect the risk. It is, as we see this unfolding. Have a very nice trading day and bye-bye.